Have you ever said, I'll start investing when the market calms down, when I've got more money, when things feel less uncertain? I'm sure those things have crossed your mind at one point or another, but that instinct might actually be costing you much more than you actually think. Hello and welcome back to Building Wealth on the Go. I'm your host, 𝗵𝗶𝘁𝗶𝗵, Portfolio Manager at KLT Partners and at Wealth Advisor at KLT Wealth Management. Today is June 11th, 2026, and we're back with our podcast doing a educational deep dive today on a topic that really is fascinating when you dive into it a little bit more and you realize the potential and the success of a simple strategy when it comes to investing and saving for your future. Today, we're talking about timing the market versus time in the market. So like I mentioned off the top, the whole concept of investing and getting started can be a daunting one for many. And I think one of the biggest things is just starting somewhere, putting a little bit away on a regular basis and not panicking when things fluctuate on a regular basis, because that's natural over the course of market cycles and economic cycles as we go. So today I want to show sort of the difference of just investing money on a regular basis, not worrying about it, not panicking when things go up and down, and versus, trying to time the market, get in and out at different periods of time, and also delaying potentially investing, waiting for that right time. So first, we've got a chart on screen and a nice breakdown. This is from JP Morgan here that talks about what missing the best days in the market actually means for you and how much it could actually cost you. So this is the chart that shows if you invested $10,000 in the S&P 500, which is the index in the US that tracks the 500 largest companies, in January of 2024, and you did that for 20 years. So held that until the end of December 2023. Had you been fully invested for that full period of time, your $10,000 would have now turned into $72,000, which is averaging about a 10.5% year return. Had you missed the 10 best days, so you just missed the 10 best days over that period of time, your total returns would have been cut in half at only $35,000. So more than half at $35,000. Had you missed the best 20 days trying to time the market, you'd only have $20,000 after that period of time. And had you missed the best 30 days, you would only have $12,000 after those 20 years. So really shows you the importance of staying invested throughout the course and going through the ups and downs and volatility and not trying to time and get in and out at different periods of time. One of the big highlights at the top here, you can see the best days are always near the worst days. 7 out of the 10 best days were within the 15 days of the worst, meaning when we're seeing a big drop in the markets, oftentimes we can't predict what that exact bottom day is or midday is, and we see an instant rebound bounce off that floor, which starts the recovery period. And then at what point do you enter? Some people hesitate on that if they are trying to time the market, because it could, historically we bounce up and bounce right back down. And so timing when that's actually going to break through can be really difficult. And that's where you often miss a lot of those days. And the one thing to know too, on the top right, you see the S&P 500 20-year rolling periods. 100% of the time, over a 20-year period since 1950s, there has never been a 20-year period in that time frame that has lost money by being fully invested. Shows you sort of the returns over that period of time. So next I want to show the power of starting early, starting soon, and what time in the market can do versus getting in later, trying to time when you buy, when you get in. And so the first chart on the left here shows the periods of time of number of positive periods. So we have days, month, year, 5-year, 10-year, 20 years. So as we mentioned, we talked about 20 years. From 1950 to 2023, there's every 20-year period that you could find in there has always been 100% positive. On a 10-year basis, 94% of the 10-year runs in there are positive years as well. On the 5 years, 88% of those are positive 5-year rolling periods. On the 1-year basis, 75%, 3 out of every 4 periods are positive years in the markets, and 63%, more than 6 out of every 10 months are positive. And on a daily basis, 54% of days are positive. So it shows you over time that percentage goes up and you have stable long-term results. This is why when looking at investments, when you have a long time horizon, you can have the ability to potentially take on more risk depending on your situation. The next thing would be the compounding of these returns over time, and you can kind of see them from the previous charts. But if you start at 25 years old, just investing $200 a month, which is a good amount of money, and we average a 7% annual return over time if you start at 25 for 40 years, when you get to age 65, you'd have $524,000. If you started at 35, you just delayed that 10 years, and then you started that same contribution, but now for 30 years instead of 40 till you got to 65, you'd only have $243,000. So we're talking about more than half, cut in half the amount of money you have at the end by simply starting at 35 versus 25. And again, these are just hypothetical returns based on a 7%, but it really illustrates the importance of starting a little something and not worrying about the fluctuations in the market, not trying to time it and riding it out over the long term. All of the data points and the historical numbers show that these have been positive over the years, and there's always something going on in the world. And I kind of want to bring that back to today. I'm going to put on screen a chart of the S&P 500 that shows the drop we saw when we had the geopolitical conflicts and the war in Iran starting at the end of March this year. And you saw the markets pull back, the S&P 500 down around 8% over that period of time. And the quick bounce we saw off of that at the end of March into the beginning of April, and how strong the rally was in April back up, and how quickly that was. And had you gotten out as that market was declining, when you re-enter, you see how quickly and how high it jumped back up in such a short period of time. That's really where you miss out when you try to time the market. So one of the best things you can do, talking about that $200 a month contribution, is contribute regularly, contribute early. My always belief too is maybe instead of $200 a month, do $50 a week. The more frequently you can contribute on a regular basis, the better it will be for you in the long run. So I hope you took something away from this podcast today, diving a little bit into timing versus time in the market and what that means over a long period of time. And you got a little bit of insight from that today. We'll be back next month with another episode of our podcast. Stay tuned for more. Leave a like, subscribe, and we'll see you soon.